Kyle Campbell, super excited to spend some time with you. We've had countless conversations on the phone, on Zoom, so it's nice to actually record this one. And for those folks that don't know you, hopefully they'll quickly discover that you're certainly one of the smartest guys in the business. Uh, but before we kind of get kicked off into some questions and topics, would you mind maybe taking a minute or two just to kind of share how you got into M&A and what you really focus on currently at One Digital on the wealth side?
Yeah, well, one, Mike, thanks for having me. I could not have known meeting you. What has it been? 8, 9 years now. It feels like forever ago. Would turn into one day being super famous on stuff like this, right? I just tell myself I now have 1 million followers on Instagram because I'm on this episode with you. So yeah, I'm Kyle Campbell. I got my start in M&A the way that most people do, which is you kind of stumble backwards into it. It's probably similar to the way that advisors end up being advisors. So often it's like I was doing this and then I became an advisor. It's a very similar story in M&A. So I was actually I got my start at a bank, um, lending to financial advisors as a specialty, and I even got into that because my dad told me that if you do what people hate, you'll always have a job. And we had a pilot program where we were lending to a bunch of different industries. And I came in and said, "Hey, what's the one that no one wants to really work with?" And they said, "Oh, financial advisors. It's really complicated. There's all this compliance. We don't really understand the business." And so I was like, "Yep, I love being gainfully employed. I will learn everything I need to learn about advisors." And I was privileged enough to have really great people take me under their wing and teach me about the business, lending to advisors, which a lot of that was M&A, and then continuing to transition and learn more and more, become a CVA, certified valuation analyst of value firms, and just continue that trajectory. And so I landed here at One Digital.
So you got your CVA. Safe to say that when you got your start at the previous bank, worked on roughly 300 acquisitions and transactions. Is that about ballpark?
Yeah, it's little under 500 now altogether in my career. But certainly my time at the bank was instrumental. So little over 300 deals there, and continuing to touch transactions in a bunch of different ways, either as a valuation analyst or as what we like to call like a deal architect, someone who just kind of connects all the dots. I had a brief season at a fellow employer of ours where we met, and as director of mergers and acquisitions there. So had a lot of opportunities to learn a lot and learn how much there still is to learn about M&A.
Yeah, and that's one of the fun things about today, right? Trying to dress it up, be a little more formal than we normally are, but being friends for about a decade, I've seen firsthand some of the work that you've done. And it seems like in our world, in the M&A space, you kind of have two different hats where you kind of have I don't want to say the nerdery, right? But like the number crunchers, the guys kind of in the background, guys and gals in the background that you might never really see. And then you have kind of the quarterback, the business development folks. I mean, maybe more folks like me that are kind of, the architect keeping the wheels on the bus and the deal moving forward. But when I talk to folks about you, you are wearing both hats, which kind of makes you a unicorn where you've got the CVA, you can run all the numbers, but you're also, having a seat at the big boy table, the adult table in the room and helping make sure that these, acquisitions start out well. And then as you have bumps along the way, you're there to help kind of make sure everything flows and then eventually gets to closing.
Yeah, and a little bit beyond. So some of my meetings this morning are in relation to deals that I closed 9 months ago, 10 months ago, who are fully integrated, but something comes up, and you spend so much time in a deal getting to really learn a seller that by the time you get to the end of it, you have so much like relational currency. It is beneficial when if there's a bump in the night to get looped back in just because there's so much rapport to build on. So that's part of one of the things I love the most about what I get to do now. Like I used to be part of deals and every deal was a project and it was a relationship you formed over 3 to 6 months and then it was over. And now I get to do that same relationship building, but it gets to extend. And so most of the sellers I've worked with have become very great personal friends because an M&A transaction is a very intimate and vulnerable experience. So you're gonna get close one way or the other.
Right.
So it's been a good gig.
So most advisors have never sold a business, right? Until they sell theirs. Maybe they have an OBA here or there. Most advisors have never acquired, some have done multiple deals. So, in terms of how you see the landscape currently, how many, because we've talked about this, there's really three kind of buckets of acquirers out there. Would you mind maybe taking us through those buckets and what advisors might want to look for with each of those types of acquirers out there?
Yeah, yeah. I think there's to your point, there's probably three main groups. And they're fairly easy to understand. I think we've all at least met or heard of each of them. So you've got kind of, I don't want to call it your bottom tier, but like maybe just your smaller, more direct to consumer approach of M&A. And that's just like the buddy level. Like everyone's got a friend, they got a buddy who can get a loan, who may be interested in buying a firm. They're typically people that you know. They may be excellent, they may be not as excellent, but typically the transaction, just the sheer complexity of the transaction is typically lower. You're thinking more what I like to call like an acqui-hire model where you're sort of acquiring someone who has a book of a business. So maybe there's an employee, maybe there's an advisor, maybe there's another employee, but typically they really are just book purchases. There's not a whole lot of mergers, there's not a whole lot of in-depth strategy and consulting, and that's where most deals live, and that's a great place for most deals to live. Like, "Hey, I know a guy, I've got a buddy, he's willing to sell or he's ready to do something different. Let's figure out how we can partner together." So that's, like, kinda your bottom tier, and then I'd say you have, like, what I like to call strategic acquirers. That's where I would put, like, the One Digitals, the all of the big names, the Beacon Points, the PAGs, the Focuses, all these different firms that have that do I say if you're doing 4 or 5 deals a year, like, you're in that camp of strategic acquirer. At One Digital, we do about 25 to 30 deals a year across 9 different industries. 10 of those will be in financial advisors, but we do work in other industries as well. So we're certainly one of those. And that's probably where the biggest deals that you hear about and the people that you know about live, where you can actually see it in a news wire or a guy whose OSJ got bought. They're typically billion plus AUM purchases happening there. And then by virtue of like the economies of scale and how all of this stuff works, these firms that I'm a part of, they're normally also handling a lot of really anything over 150, 200 million in AUM, like and under say 5 to 10 billion in AUM are all happening within this group of strategic acquirers. And then above that, you've got the mothership. That's the actual private equity firm who's living, if not at the end of the chain, somewhere very close before you transition into a public, like an IPO or something like that. So those are kind of the three groups, and knowing what each of them do and how they orient around the space is pretty helpful.
Would you, so we talked kind of that first rung to the third rung. Can you also kind of start putting firms in boxes as to those that are focusing on like the BD versus hybrid versus RIA advisors? Is there a clear distinction between acquirers there as well?
Yeah, yeah, for sure. I think maybe not quite three at this point, but if you're thinking about like an LPL or an Osaic, who if anyone's going to buy a broker dealer like centric book of business or work with an advisor in that lane, like those are the folks that are going to do that. The actual broker dealer is pretty much the only person that has direct value in that type of firm primarily. Obviously, they can convert into more value, but like that's one level. And then you've got like your hybrid shops, which is actually a fairly small group of people, at least on the strategic advisor level. So I would say like the average buddy level of like, hey, I got a buddy who's buying or selling. that's a lot of like a lot of hybrid business, a lot of hybrid deals happen there. Probably the vast majority of hybrid deals. Like just think, I've got a friend who's got 35% of his revenue at the broker dealer, but really styles himself as like a fee planner focused advisor. But he's got this legacy BD stuff and he does a little bit, but he's not necessarily farming annuities every single year. It's just opportunistic and there's some of that. A lot of that is happening. And the buyer pool there is actually really small in the sense of strategic acquirers, very large on the buddy, sort of level of just guys knowing guys or gals knowing gals. But the strategic acquirers, it's a pretty small ecosystem because there are very few private equity firms who are super interested in getting involved in the broker dealer space. So when you think about strategic acquirers, they're almost always private equity backed. So the value that they're trying to generate is typically upstream to either their existing private equity shareholder or the next trade. And those folks aren't super excited about more brokerage business. So what happens is it's a pretty small group of folks who are interested in buying a billion-dollar AUM shop that is 30 or 40% brokerage revenue. It's just like because that's beyond the buddy level of being able to go get a loan for, but the private equity money or PE-backed strategics, like, there's not a ton of those either. A lot of them are just in the business of kinda getting over fully to, like, a fee-only model. So that's kind of your middle level, and then you've got the RIA only folks. That's the vast majority of the biggest firms you've heard of. They have, in aggregate at least, they've got the highest multiples. They've got probably the most marketing, and it's really where the majority of the PE capital is spent on that RIA fee only side. But those are probably your three different tranches, and it's again, it's all run by following the money up to the top.
Right. Okay. No, that makes a lot of sense. So following the money might be a good segue. And we talked about this several times, right? But the way that you see it, right, as this the chess pieces kind of evolve and move around our industry, seems like there's a few different ways of looking at it. But you have the next 2 to 3 years, and then maybe five's too soon, but that 5 to 7 to 9 years out. So in our previous conversations, we've kind of talked about the next 2 years in terms of what's happening to valuations versus the long run. But would you mind maybe taking us through kind of your thought process on how you see the board evolving and changing, and then we can dive a little bit deeper in terms of who you think's going to be winning kind of this game going. So the next 2 to 3 years versus 7 to 9 years out.
Yeah, yeah. I mean, all the caveats about my own opinions being my own opinion and all that stuff. Don't sue me, anyone out there. But I think what we're seeing is like again to your point, you follow the money. So much of the value in the space is directly derived by private equity investment. You can look at the average multiple for the same exact type of shop for an advisory firm 2010, 2011, 2012, 2013, 2014, around that range. Forget all of the market upheaval that might have been in 2012 or the afterglow of 2008. Just the pure value was so much lower for any given firm. In some cases, like 2, 3x, like with 2 or 300%, like just lower across the board. A lot of reasons for that, that increase in value. One, it was just access to financing, right? So you increase supply, or rather, you keep the supply the same, but demand gets increased, and the ability to execute on that demand gets increased with folks like a Live Oak Bank or PPC loans or whatever, advisor specific lending. And then you've also got private equity firms who are overpaying for, say, the buddy level can afford to go get a loan for a $50 million AUM shop. And so they do. And then at the strategic level, those folks need private equity backing, and private equity is looking for big bites at the apple. So they'll overpay for scale, right? So you'd overpay, quote unquote, based off the valuation for a $500 million or $1 billion shop. And that creates a feeding frenzy for everyone underneath it, trying to scale themselves to the point at which they get into a new class of buyer, and then they can upgrade their own value. And right. So you have this like trickle up effect of valuations rising and rising over the last decade. And you get to this level where it all stops and starts at the top with private equity. And yes, we've had a banner 2 decades from a market perspective. Like, it's been very hard to be wrong over the last 17, 18 years as a financial advisor, at least, year to year. But there's also this reality that these private equity firms have had so many tailwinds in order to invest in this space, and some of that is shifting. So right now, PE still has a ton of like what I would call dry powder, right? Like, so they've still got a lot of money to spend. And so even though everyone who knows anything agrees that, like, okay, well, you can't just have year over year record highs in the market every year forever, right? Like, that's not a thing. We're 5 years late on what we all expected to be a recession, and every year everyone sort of knows we're getting closer. PE ratios have been way too high for way too long. Like, all of the analytics say the same thing, but it hasn't happened yet. And so normally that would get priced in, but the amount of cash that's undeployed is so high at the private equity level. The valuations are still keeping up, even though like the underlying analytics don't support the valuation still being that high. You do have to prepare for a market drop. So over the next 2 to 3 years, even though the math doesn't necessarily support it, I expect things to be business as usual. Premiums to stay basically where they are, maybe even increase. But that's a different story for what happens over the next 7 to 10 years, where we all agree we will somehow, some way have a correction, right? We can't have PE ratios in the high 20s for a decade. It's just not the way that our economy works. So we know that there's going to be some sort of correction. And all of a sudden, we're going to have a few different cascading impacts at the same time. You don't need to be a CVA to understand what makes something valuable, right? If there's a limited supply of it and it's cash flow generating and it's not very risky and it sort of comes with liquidity and all these different things, you're talking about something really valuable, which is why financial advisory firms have been so valuable. But what we all know to also be true is most advisors do not grow organically. They don't have new clients. 2.5% is like industry average on net new assets. I would I would say that most of the time when we peel back the layers, it's less than that. Many folks are negative on net new assets while still being up in revenue because markets have been so good to them, or they've got enough sort of embedded relationships that there's a little bit of ways to sort of game the system as they switch from broker dealer to fee revenue. Like, you get pickup in income and all these different things. So the average advisor isn't growing. They haven't grown in 2 decades, but they're more valuable than they've ever been because their revenue's higher and it's higher every year. The talent hasn't gotten better. The product hasn't gotten better. The situation surrounding these properties has been so beautiful that the value is embedded in that. And so that means you have advisors who, frankly, the market would have forced out of the business. They would not have been able to maintain their quality of life. They would have sold because they weren't growing. And without a great market to just prop them up, they would have had a lot of work to do. Most advisors are not working a ton. They're understaffed. They're able to be understaffed because the markets perform so well. And what we know is that when clients have high returns, they don't call very often. No one's calling to talk about their 13% return, right? But when markets are choppy and things are bad, you have to answer the phones. You have to service clients. You have to actually work the 50, 60-hour weeks. There haven't been any of those corrections that normally force out older advisors. So the average advisor age is staying up. So when we do have that, when that proverbial diaper hits the fan, what you're going to get is a bunch of advisors flooding the market because they haven't been selling because they've been in active retirement. They already golf 3 days a week. They do what they love. They hang out with their best clients. Most of their clients don't call. They pick up money just sort of by existing and maintaining a good smile, and they're not working that hard. Um, and that's going to change. And when that does, you're going to have a whole lot of folks who would have sold 5 years ago, but happened, hitting the market at the same time, which is gonna drop valuations, and then you're also gonna have a correction, which is going to build in the risk premiums that haven't really been built into a valuation over the last 10 years on the market side, because we might know there's a risk coming, but if you've gotta outbid 10 other people, you can't afford to be the one person saying the sky is falling, right? You've just gotta pay what you've gotta pay to win that opportunity. And so over the next 7 to 10 years, there's no reason to think that the smart money at the top is gonna keep paying valuation prices that they are when they won't have a need to anymore. There'll be more supply. Money is not as cheap as it was, to even get, right? So their cost of capital is higher. And most of them, I mean, we're in the consolidation phase now. They will have gotten most of the scale that they need to be able to just play bully ball with the market. It'll be 10 to 15 consolidation firms that are dominating 90% of all of the capital that there is to deploy. And it's not a very great thing for folks who've stayed on maybe too long. But over the next 2 to 3 years, keep it running.
That's fascinating because I think we can easily say, like you mentioned, we've expected it for a few years now. To me, it doesn't seem like there's a whole lot of people sharing this part of the story. We try to do that with what we're doing. Um, and 70, 75, 80-year-old advisors probably never going to retire, right? Most advisors, however you want to say it, pass away at their desk, right? They have a continuity plan, they pass away at their desk. So it seems like, okay, so we take some chips off the table. I think you and I view that differently, but you have to take the chips off the table. There's a partial sale, or take some chips off the table, sell your business, and now be a W 2 of, say, One Digital, and allow us to help you grow your business through marketing and referrals and leads from the benefit side. Um, could you maybe talk about that a little bit? I mean, what are the options? You run your business into the ground, and that's the advisor's right. And candidly, I totally understand why you do that. I'm
If
making $1 million a year,
yeah.
working 30, 40 hours a week. I've got a good quality of life. I see my kids and I travel with them and that sort of thing. It's hard to replace that cash flow unless you're very, you're involved and you've got other things to retire to and you've got enough of a nest egg. But walk through how advisors should be thinking about this. And then sounds like some of them will be forced regardless to have this conversation.
Yeah, I would say that if an advisor is not planning to sort of die at their desk, so to speak, then this conversation is happening for them whether they want it to or not, right? Like it's just it's going to be your reality. You're either going to have to merge with someone as to try and create enough scale where you feel like you can be in the driver's seat, or you're going to have to partner with someone who does have the scale and to your point, take your chips off the table. And that can look like a few different things, right? It partial sales, which have become fairly popular, but I'm unashamedly against, right? Like I'm not a fan. I have to express my bias so that people know it's a bias. I don't think that partial book sales are like from an equity perspective, saying, "Hey, I'm going to sell someone 30% of my business to partner with me." There's a 5 to 10% group of advisors where I think that could be a really beneficial like move for. But the vast majority of advisors, I'm like that makes
Presuming you're receiving equity in the overall, say, RIA or entity, that might make some
yeah,
sense.
like when someone comes in, let's say private equity comes and says, "Hey, we want to buy 30% of your firm. We're going to capitalize you and we want to help you go buy other firms." That's a great opportunity. When someone is willing to capitalize you to then increase the value of the asset that they already purchased, that makes a ton of sense. When someone is saying, "Hey, take some chips off the table, just sell me 20% of your firm and or 30% of your firm and I'll just let you keep doing your own thing and ride off into the sunset, and I'm not going to help you with anything, but I'm not going to hurt you with anything, but this is just a liquidity event." I struggle to like put pen to paper and make sense of that. I feel like it's an emotional win, certainly, but it's not a strategic win. The reality is once someone like that, especially when we're talking about captive places, LPLs, Mosaics. broker dealers, some RIA, some OSJ platforms. Anytime you're an independent advisor and then you take an investment from a place that kind of takes away your independence, um, you're not really serving yourself. And the value of your firm when you've got a private equity partner who is not actually incentivized by all the different things that we are assuming that every valuation makes presuppositions about what's happening. If LPL takes 20% of your firm, they give you some money and say, hey, keep doing what you do. That sounds good. When I come to make a bid on your firm, a normal investor is only interested in a return on their investment for that asset. So LPL says, hey, I paid 10x for your 20%, 10 times EBITDA for your 20%. And someone's coming and saying, hey, we'll pay 12 times EBITDA for that 20%. Normal investor says, yes, great. I made a return on my investment. Like, let's move on. LPL has no reason to say yes to that. They have no reason to be in support of the actual appreciation of the value of that asset. They have gotten what they wanted. They've made it harder for you to leave. And when it's harder for you to leave, you have less options. When you have less options, you have less leverage. When you have less leverage, you have less value. It is hard for me to get a firm out of the LPL ecosystem, period. It's even harder when LPL owns 20 or 30%, which means they have to be made aware when someone puts an offer on the equity. So then they get to know things that they would never know at an earlier pace than they would ever normally have it. And if they decide to frustrate that process, which they can in 15,000 ways that are difficult to sue them for, it basically truncates your value. And it all looks like they're just being a nice guy or gal. But I would say that I don't trust organizations to look in my best interest when it's in their best interest to do otherwise.
So a financial advisor centric firm may not have the financial advisor's best interests at heart. Is that what I'm
I,
hearing?
listen, I know it sounds crazy, but also, maybe the government isn't spending our tax money very well either. It's that I don't want to get canceled. That's another conversation for
Yes.
another time.
Well,
But
and I was going to ask you, so, and you articulated that very well in a very gentlemanly like way. So you're in RIA, a hybrid, and OSJ within an LPL. Could happen in other places, to be fair. And they come in and buy 20% of your firm. I think there are some people that might think like, "Oh, you've got some inside knowledge of baseball," but in my mind, when you live, breathe, and eat this stuff, and it's like enmeshed with your life, right? Like raising kids and doing what we do, it's just it's all day, every day, right? The brain doesn't turn. They would have you think that like, "Oh, you've got some inside kind of knowledge," but doing as many deals as you've done, working with RIAs and OSJs, if a large platform like an LPL comes in and buys 20%, safe to say that it makes it a little bit more difficult for other private equity backed folks to want to open up the contracts and share everything with the other entity. But it seems kind of like there's a clock on when do we own the rest? Am I wrong?
no, absolutely. It is
Not
complete.
always.
Yeah, I mean, everything is, I don't want to speak too monolithically, but I think incentives drive behavior, right? Like we all believe that. So I really, really, really want my wife to like me. So I put the toilet seat down. And it's only really her liking me that makes me, incentivized to do that thing I wouldn't normally do, right? She had to train me in the first 3 years of our marriage to really put that toilet seat down. In the same way, like it's human, it's natural human behavior. It doesn't have to be a pejorative on any firm or like LPL is full of bad guys. I have friends that work there. I have sent folks to LPL when I thought that they were like that was a good fit for them. So I'm not saying that LPL or picking on them or any large strategic, but I'm just saying if someone takes an investment in you and they make more money on you simply existing on the platform by just keeping assets there because of the cash sweep, right? Like LPL doesn't make money servicing advisors. They make money taking a sweep on all of the cash sitting in the accounts. So their incentive is not to drive better service, it's not to drive a better product, it's to keep people on platform as long as they possibly can. That's it. That is the actual core incentive for their business model. Everything else is incidental. So when they take an equity stake, you should start to wonder, like, how does this align with their core incentive? How does them taking a 20 or 30% stake in your firm make it more likely that you stay on platform? Now, there's the top level of like, well, hey, I like them. And maybe they say they're going to help me buy more businesses within this ecosystem, or they're going to give me preferential treatment or whatever. There's all of that, and that could certainly be true. But at the end of the day, you are almost certainly artificially deflating your terminal value. Maybe not today, but in 10 years, 5 years, whatever, because you have limited your pool of buyers. It's very hard to go do a deal with someone when the competitor that I would have to be negotiating against gets to see every good or bad thing about my deal. They also are a party in the negotiations, so they can frustrate the negotiations on issues that don't matter to them, but do matter to me and you, right? There's 3 of us in this relationship now instead of 2 of us. And it's very, very easy for a third party who has an equity stake to frustrate a transaction. It's even easier for the third party who owns all of the administrative and logistical keys to turn to actually extract that business to frustrate it. So they can do different things like say, oh, yeah, you own your clients. You can sell to anyone you want, but you don't own the client data. LPL owns client data. So when you go to someone and say, "Hey, I want to transition my book of business," well, yeah, you can leave, but you'll have to repaper like as if you're a wirehouse. No, no client
And
data,
it's
and you don't
and
even have
it's
protocol to
and it
protect.
and to be fair, it's good for the shareholder, right? So for some of these principals and founders, most of them in their 60s and 70s, there's some late 40s, mid 50s, but they're being pressed. Right? Like, hey, what's the path? You either leave and take half if you're lucky, or you stay and just kind of, you know, we kind of joked a few weeks ago, yes, sir, I may have another. And but you're being forced to make these decisions. So good for the shareholders, but for the people, and I know you're in that world, we're both in that world. I work with RIA owners and OSJs, but it's really, for the larger firms that have several hundred to maybe 800 or even 1,000 advisors to fill you with your RIA, the question for those guys is like, what's going to happen to me in my business? And if you want to retire in the next couple of years, like maybe you're fine. But at some point, you just have to know that, hey, changes are coming. And if you just pay attention and care enough about your clientele, like anyone should be able to see and have the conversation that we're having. And maybe they're afraid to have it or they just don't see it the same way. But it kind of seems obvious at this point.
It is obvious, but it's more obvious when you have had to be the person going and doing the thing. So when you're just talking about selling to someone, like the conversation is really easy to follow. Like, "Oh, okay, well, LPL's got, so and so. I don't even want to use LPL. So and so has 30% of the business, but hey, I got cashed out on that piece. I'll be worth more in 5 years. And so, when it's time to like trade out, they get their money. I still got, my upside and I took some chips off the table and everything's fine. And like that sounds good if you're not the person who has to go through all of the complicated tasks it takes to actually take a book of business that someone owns. I'm not even talking about a wirehouse where things are a little muddy. I'm talking about independent advisor at an independent OSJ on an independent platform that supports independent advisors, right? All of the independent categories you want to add. The logistics of actually extricating that independent value starts to feel real, captive, and when you've done that, you start to realize all the ways that an LPL or an independent partner can frustrate the process when they don't know what's going on. When they find out last minute, when you have structured things to be as far in your court within the legal framework as they possibly can be. It's very, very easy for just one personality, forget right or wrong, just a person who doesn't like you or who you offended because they had planned to sell their whole platform to someone else, and you leaving means 7% of their overall AUM is gone, and so they're making less money on this deal. And like whatever it is, their ability to frustrate that transaction is incredible when they don't know what's going on. When they do know, I would say it simply cannot be done unless you're willing to start over, basically, as if you were at a wirehouse. That's a lot of trust to put into a Fortune 50 company.
It's a massive amount of trust. Time for one more question. I could talk to you all day. Are we moving away from the roll up model after what we saw with Focus Financial going private?
Yes, no. That's my quick answer. We're moving away from the traditional roll-up model based off of trading out to another partner. So the historic roll-up model, let's say prior to 2023-ish, 2022, um, I get some PE backing, I overpay. Let's just say I'm worth 13x. I buy a bunch of people that would normally be worth 10x and I pay 12x for them. So I still get a little bit of arbitrage between me and them. I get big enough where someone worth 15x will buy me. So now all of me, I'm up 2x from 13 to 15. All the people that were overpaid before, they get overpaid again. Now everyone's worth 15. Then we keep doing it. Now we get to pay people 12x because we're worth 15. And if we get big enough, there's someone worth 17 or 18 who will pay 16 or 17 for us, right? And you keep scaling that. And there's no need to operationally align. There's no need to brand. There's no need to drive true synergies beyond like accounting and HR, right? Like there's and maybe an investment platform, but probably not even an investment like philosophy. So that historical roll-up model that it only exists to keep everybody together long enough to get flipped to the next person. If anything, it's almost counterintuitive to actually integrate, because what's the point of integrating something you're just gonna have to break apart for the next buyer in 3 or 4 or 5 years anyways, right? So that historical model, which Focus was relying on, that is dead. There's too much risk in the market. There's too much risk of downturn, economic downturn. We all know advisors don't grow organically, not anymore. It's primarily market based. So all of those sort of comorbidities come together for PE to say like you can roll up as much as you want, but you've got to have something that's operational at the end of the day. Like we can't, there's no one else to flip it to. We've gotten as high as we can go. I mean, there are RAs that are worth 23 times. Think about that. Like what equity in in the public market is worth over 23? You're talking like top 50 firms, like top 50 equities and securities like in the world. So, there's no one to buy that at that point, like, there's no one to flip that into another value where you can make your money and still sell like, it's gotta be something that can operate on its own and continue to generate that value. Roll-ups historically don't do that. A new version of, like of integrators, not aggregators, but integrators who are continuously building the same ship and adding on like, "Oh, man, you've got great stuff. Let's you into what we do and take what makes you great and leave the stuff that maybe is just average and keep growing it, like that is absolutely still on the table. And that's actually where a lot of the private equity firms are placing premium, huge premium.
True, false question. Last question. Is it true or false that you are starting to see the amount of the window where normally a PE back firm, a PE, top of the food chain would flip in 4 to 5 years, but it's actually taking them longer than they would like to sell that asset?
To an absurd amount. So very, very true. Almost twice, bordering on twice as long. We'll see what happens over the next year. But
Stakers.
very, very not good for people who were hanging all their hats on. Well, someone's going to come buy us for more than what we're worth. I,
Awesome.
yeah.
Kyle Campbell, it's always a pleasure, man. Thank you. I'm grateful. I appreciate you.
Love you. Mean it. Appreciate you for having me. Thanks, man.